Hey guys, and welcome to today's video. So in today's video, I'm going to be going over the ideas of the fair value gap because I've gotten a lot of questions on the fair value gap as regard how far um, will price reach into the fair value gap for entries. So in this series, I'm going to be um, enforcing the ideas of fair value gap, and I'm going to give you the variations of entry using the fair value gap. So this is going to be series one of five series on fair value gap for entries. So um, I would advise that you watch this video a couple of times to really get every details in this video. So I'm going to be just going over the initial idea of the fair value gap, um, what the fair value gap stands for, why we have the fair value gap in price on this first series. Then, in subsequent videos, I'll be giving you the various variations of the fair value gap. So, when we talk about the fair value gap, you want to say we're actually talking about a location in price, an institutional reference point in price where um, price will reach for in the nearest future, or price will trade from in the nearest future, or at the time of analysis. You want to say where the perceive price, where the market maker actually perceive price to be fair valued. You want to say we're actually referring to an area where if price gets to the liquidity at that area is being tapped. You want to say, and two things can happen at that area. You want to experience either a retracement or a pullback, as the case may be, for higher prices, or you want to experience a reversal automatically at those areas. You understand? Say so. It's usually an area you want to say where um the market makers will perceive price to be fair valued. Either it is very expensive at that price, or it is actually very low. You understand? Say at that price. You understand? Say they don't want to do anything. You understand that region? They either do two things: take out their orders that they already have in the marketplace. You understand? Say, or take their partials and go to fill in their pending orders. You understand that they have for the other side of the marketplace. So that is the idea surrounding the fair value gap. And also, the fair value gap is not the same thing as the imbalance. You want to say the imbalance is different from the fair value gap. The fair value gap is a just little gap in price. I'm going to be giving you an illustration with the diagrams I have right here and the chart you can see in front of you. The imbalance is, in other words, the an inefficiency in price. You understand to say where price traded on only one direction. You understand to say that is what the imbalance stands for. But why the fair value gap is a location in price where the market makers perceive price to be probably quite expensive or very cheap. You know what I'm saying? So they want to take price in the next direction, either by retracing price or reversing price. You know what I'm saying? And that is what the fair value gap stands for. You know what I'm saying? And there's another area of dimension of fair value gap which also found at equilibrium, but that's not what we're actually going to cover in this series. We're actually talking about the fair value gap in terms of um, looking at an area of liquidity. You want to say an area of reference. You get that's what we're actually covering in this particular video. You get so if you look right here, this shaded area right here, you get what I'm trying to say. You can see we have this one candle, this next candle, and this other candle. This right here is a fair value gap. Why? Because why is it a fair value gap and not an imbalance? Why? Because this low failed to get to this high. You understand? Say this low failed to get what to this high, and price later on in future came and traded above this high. You understand? Say into this fair value gap, and that signaled an entry right there at this particular region. So if I have to drop to the lower time frame, which I'm not going to do because of I want to make this video as short as possible, is you're going to find a precise entry in terms of probably an order block right there. But what you want to look out for in this first series is you want to just see price trade above this high right here, this particular high. In terms now, we're looking for bearish moves. Why? Because this is a bearish fair value gap. You understand why? Because we have the candle that's actually the fair value gap is upon closing downwards. So we're anticipating lower prices. Is that also? So we want to say price just straight above this high of this particular candle that failed to get to this low. Let me make that very obvious. This is the high I'm referring to right here. You understand? The high of this particular candle that came in at 39,985. You want to see that's a particular high we're actually looking at. So we want to see price trade into that just above the high. So once we see price trade above the high, that signals us for entry. So we want to look for entry opportunities at that area and start selling downwards. You understand? And you can see the way price responded for a period of time once it traded through the fair value gap. You understand? So on this day, it traded into the fair value gap. The next day, we saw a bearish decline in price. You understand? Even at that particular day too, there was also a bearish decline in price. So this an area where um they perceive price to be fair valued. You understand? They were actually buying, they started buying their positions from this low right here and started taking price to this into the fair value gap. And when they got to this fair value gap, they perceive price to be very expensive. You want to say expensive to keep what? To keep buying. So what did they do? They sold. You want to say, and that's what happened right here. You want to say later on we saw them keep buying price. You want to say to the upside. So that's one example. The next example is over here, right here. Mind you, this chart is as far back as 2018. You want to say I didn't cherry pick anything, so you can just go over your own charts and still see things for yourself. Um, right here is another example. This is the daily time frame I'm using. Mind you, I told you the fair value gaps on the higher time frames are the ones that actually hold true. I can actually show you these things on the lower time frame, but I'm trying to build an idea in your mind that the higher time frame is king. You know what I'm saying? It's where you want to start your analysis on. You want to say when you can you can't be wrong. You want to say when you start looking for this institutional reference point on the higher time frame, you want to say 99% of the time you always be right. Only 1% of the time will you find yourself being wrong when you start your analysis on the higher time frame. You understand? So, or when you look for these institutional reference points, we talk about be it the fair value gap, the imbalance, or the order block on the higher time frame. So that's what we are experiencing right here, and that's why I'm using the daily time frame. So right here also, we can see okay at this candle, this region right here, 1, 2, and 3. You understand? There is a fair value gap that formed right here, and later on in price, we saw price trading into that fair value gap and there was a quick response in price higher. So now, why is here a fair value gap? Because we have 1, 2, and 3 candle. Now, this low failed to get to the high of this particular candle right here. This validates this area as a what? A fair value gap. And later on, price quite of at a point traded into this order block and somewhat responded a little, but price cannot ignore this fair value gap. And later on, we saw price come into that particular fair value gap and there was a quick response in price higher. You get what I'm trying to say? That's number two example. So if we move forward to in price to, I believe we have a couple of other examples right here that will also engrave the idea into your mind. You know what I'm trying to say? So right here too, we also have a fair value gap at this region, at this 1, 2, and 3 candle. You want to say price um fail to get to this high from sorry get fail to get to this low from this particular high right here. So you can see this little space or little void in price. Price later on came into that particular area, you know, say, and sold down. You know what I'm trying to say? Price came just trading above. So this is the first entry style I want you to learn. Once you see price just trade above this high, if it's a bearish move, you understand you're anticipating and you see a fair value gap, you only want to see price just trade a little above this high price. Once you see that, that should be your signal for entry. You understand? You can enter your price there. Let's say you enter at this region, immediately you see price trade into that area, and you can place your stop loss just above this fair value gap at this region. You understand? But that means if your depending on your risk management, if your risk management will not allow you to put your stop loss at this region, that means you're going to reduce your lot size or the amounts or the position that you're going to be risking to allow your stop loss to be at this region. Then once you see a quick response in price, you want to say, which I'm going to be talking about in the next series, you want to say about these fair value gap entries, you're going to start adding your other positions. You want to say why pulling down your stop loss. You want to say good. So that is how you enter here, and you can see how price responded quickly just as it traded above this particular high. So if you also look down here too, we also have another example. So there's a fair value gap here. What's the fair value gap? 1, 2, and 3. You know what I'm saying? Later on, price went higher. You know what I'm saying? Came down into the fair value gap, and since then we saw a quick response in price to the upside. You know what I'm saying? The fair value gap is 1, 2, and 3. This low failed to get to this high. You understand? And we saw price coming into it again. So look at how this entry is very precise right here. Price didn't wait to get to this high here. It just tapped through these lows. And based on liquidity, we can also see a series of lows right here. You're on a series of low. This is double bottom right here, and price always like this area. So there's a confluence of liquidity right here, not just the fair value gap, but also double lows. You understand? You get double bottoms, and price traded into it, taking out the double bottom and also coming into the fair value gap, just tapping below this candle, and there was a quick response in price. So your first style of entry using the fair value gap is you want to anticipate price just trading above this high. You understand? And watch the reaction in price. Once you see a good reaction in price, I can signal an entry and say that will be your entry. You understand, for the fair value gap. I'm going to go over various variation. I said that earlier, so you can just stay keen on this channel. I'm going to do a lot of other variations on how you can enter. I'm going to say so. The next example, I believe this should be the last one, 'cause I'm trying to make this video as short as possible. Is we have one, two, and three candle. This is the high to this particular low right here, and later on we can see in price came into the particular fair value gap. You want to say also tapping into these other blocks right here. This is a triple bull pattern coming into almost what is known as the mean threshold, because if I join all these candles together, this area right here will actually be the mean threshold. You know what I'm saying? Or almost the mean threshold. But I'm sure that this okay. Let me just outline that so that we'll be sure. No assumption, so that you'll be sure what you're doing right here. Okay. So that is not the mean threshold, because the mean threshold is actually this area here. So this is actually the mean threshold here. So that is not that the area where price traded into was not the main threshold of the order block. But we can also see that price actually also traded into the order block. You understand, not respecting the low, nor respecting the open price over here. Neither did it get into the mean threshold. So it is very clear that the price actually came for this particular fair value gap right here, and that's what we outlined here in price. So price just came above this particular high, because this high failed to get to this low right here. And what happened? We saw a quick response in price, and the day after this particular candle, one, two, it was throughout bearish. You want to say even trading into another fair value gap right here. I failed to outline right here. There's another fair value gap right here, and so you can see this out in price here. There's another fair value gap. I believe the reason why I failed to outline it is why, because this fair value gap is another variation. This is another variation. You know what I'm trying to say? It traded past the fair value gap right here on this particular candle, responded on this next candle, because you can see the wick on this particular candle went higher. You know what I'm trying to say? So if I go to the lower time frame, you can see there will be more like this kind of pattern. Price traded into fair value gap. Price responded with the fair value gap, and eventually price went for lower liquidity. So this particular um from this point to this point would have been your fair value gap entry, especially if you're trading on smaller time frames like the 15 minutes or the 5 minutes. This would have been an entry for you, if you wanted to use this particular fair value gap low right here. But if you also want to include deeper liquidity, then you watch out for this particular low right here, and that's what price came for eventually. But the idea I'm trying to engrave in our minds in terms of the order block, sorry, the fair value gap rather, is that once you see price trade into that area, you know what I'm saying? Let me show you. Let me just come up with a picture very as quick as possible. So I'll color this black. So let's say that's black right there. And I'll paint this black also. Okay. So this is the low of this particular candle right here. This is the low. So this is a bullish fair value gap. This is how a bullish fair value gap will look like. You want to say we have a lower candle, the middle candle, and the other candle. So the low will always fail to get to the high, and this is where the high will likely be for the bullish fair value gap. You understand? So all we want to see in price, we want to see price come later on in future, trading just tapping into it. So this should be your first variation of entry using the fair value gap. So want to see price just trade a little into that low. Sometimes it could go beyond. I'm going to discuss the other variation. I've said that over and over again on this particular video. So let me just continue. So you want to just see price come below this particular fair value gap, and from this little entry right here, you want to see an expansion higher. You want to see. So this is how you're going to trade the fair value gap, the first style of entry trading fair value. You just want to see price just come below that low. The reverse will be set for the bearish fair value gap. And okay, let me just do that for us, just for the sake of understanding. um and bring it here, another one right here, and eventually something right here. Yeah, okay. This is okay. So I'm coming, I'll change the colors to really, but mind you, I said in the fair value gap video I did before earlier that the colors does not matter. You know what I'm saying? The colors does not count. But just for the sake of understanding, I'm going to just touch the color so that we can see it, somewhat like a difference in delivery. So that's a 10. Wow, good. So right here we can see our price created a fair value gap. So this is what a bearish fair value gap is going to look like. Trying to give us a pictorial representation. So we want to see price later on in future retrace just above this high, just a little bit above this high. You understand? To say the first style of entry will be just a little bit above this high. Then you want to see price expand lower. You understand? So that's what you saw in a scenario like this right here. I always saw in a scenario like this over here. Price created a fair value gap. Later on in future, price came trading just above this particular high, and we saw a quick response in price lower. So this is the first part series of trading using the fair value gap and how you should enter. You understand? You just want to see price go above that high or above that low, depending on the kind of fair value gap you're looking at, whether it's a bullish or a bearish fair value gap. You understand to say? So sometimes price may not get to the fair value gap. Price may tap into liquidity. Mind you, I said in one of the videos I upload on this channel that what price is actually seeking is liquidity. And when we talk about liquidity, we're actually talking about where the money is. You know what I'm saying? So I'm going to be talking about other variations of the fair value gap. Because if you look right here, also this is also a fair value gap. You can see the way price traded down into this fair value gap right here, just below this low. So you can start timing your entry below this low. But we can see that price traded deeper. You know what I'm saying? So I'm going to explain these other kinds of variation, you know what I'm saying, of the fair value gap, and how answering those questions of how deep we price actually go into the fair value gap, and believe that will also help you in your trading going forward. You know, say for profitability or finding those sniper entries that you need and you desire on the marketplace. So I believe I've answered your question to an extent. If not, still leave your thoughts in the comment section. Maybe I went over something in this video very, very fast. Maybe you want me to re-explain it or really um reinforce the idea again, like I'm doing right here. I'm going to do that for you. You understand? So thank you very much for watching today's video, and see you in the next video.